Phil, what's the single most important thing that you have learned about investing over the past 3/4 of a century?
Patience.
Patience. Expand on that. How do you apply patience?
Well, I buy things for myself and for clients to hold for 5 years, 10 years, because I won't be around for 10 years or any sizable part of it. But
you've fooled us before. You could fool us again. One of the most remarkable things about you is that you don't rest on your laurels. You're out there every day as an active investor. What do you think of this stock market today?
I think it's dangerous at present levels. A lot of froth on the boom. I think probably we're in for maybe something like 1987, when the market went down 500 points in one day. Perhaps we'll have a repeat of that. But in the long run, this is a great country, despite having too much government. And I think in the long run, the market will recover, and people who buy the right stocks and sit on them are going to do very well.
What do you do, given your experience, when you think there may be too much froth, when you think there may be a major correction, even a crash? Do you sell all your stocks?
No, I really don't do anything.
You just show that patience, huh?
I bought them for the long pull, and I've seen a lot of recessions, and I can live through them, and I can do it again, perhaps.
All right, welcome back to
Stocks and
episode 7, and we're going to be speaking about patience, the backbone, the key fundamental attribute to investing. That was Philip Corrett, and he was speaking on over 70 years of experience in investing, and the first thing that comes to his mind and the key attribute you have to have is patience. Now, when you invest in the stock market, certain people see it like a slot machine. You put money in and money should come out immediately, or if you're going to put money in, you should lose it immediately. And both of those two things can happen. You can make 100%, 200%, 300% overnight, and you could also lose it, But as you can see from the quotes below, the big money, the real money that's being made in the market, as Charlie Munger says, the big money is not in buying and selling, but in waiting. Having the ability to wait, having the ability sometimes to not buy, having the abilities to not sell. The way, with the introduction of Robinhood and M1 Finance and Webull and all these different investment tools, WhatsApp and even JP Morgan Chase, if you have a Chase account, they're encouraging people to invest. And when you have these apps, you see in red, green, flashing lights, news everywhere. All these things are trying to trigger the brain of the retail investor, the amateur investor, to do something active, right? And activity is the enemy to investing, to be honest with you, because as Mohnish Pabrai was saying in one of his seminars, TD Ameritrade, they looked and examined old accounts, and there were a few accounts that were just outperforming everyone else's by a landslide. And these accounts had something in common. When they founded the account, they found that it was either two things happening. One, the person just forgot about the account, meaning they invested, they never looked back. And the other ones were people that were dead. So the inactive investor outbeat the active investor, right? Because think about this. All right, if you know something that you have background in, something that you've done for a number of years. I did weight training for a number of years. So I understand that it's a patient thing. Ultimately, the ones that benefit from trying to be healthy and stay in the gyms are the ones that make it a lifestyle, not the ones that are trying to look for a quick transformation or, a month in, they don't see any results, they couldn't give up. The ones that are rewarded are the ones that ultimately have the patience to keep going to the gym, keep eating right, and eventually make it a lifestyle. They're not worried about it anymore or see it as a burden. They just do it naturally. You have to have the same approach when it comes to stock investing or retail investing real estate investing is a great deal of patience. Now, stop the video and think about this. Is there something out there in your life that you've had experience with for a number of years and understand that there's a great degree of patience? You understand that there's a great degree of patience required for your particular skill set or something that you might have done throughout the years, but someone new approaching that skill set or career or whatever you might have, they don't see it. And through impulses, they tend to fail at it. Now, I'll say this much. Have we come across people or experienced ourselves situation where we made money really quickly overnight? Yeah, sure. That happened, but you could also lose it very quickly overnight. Most of the money you're going to make in the stock market is going to come from waiting. If you've been watching these videos, you understand how to pick a company. You don't go based on what the market is saying. You don't go based on market price. As Benjamin Graham says, the market is manic depressive, right? It's always throwing different prices at you. In the short term, it's a voting machine, but in the long term, it's a weighing machine, meaning over time, a stock's true value is going to show. But in the short term, it's just people voting on what stock is the best and what stock is good, what stock is bad. Prime example is Apple. Now anyone wants Apple at any price they could have it. But 4 years ago, 5 years ago, no one wanted Apple. Only the people that wanted Apple was the ones that understood the value of the company. You know, and hopefully I'll do a lesson on valuation, how to value a company. But in quick terms, the value of a company, it's the total asset minus the liability minus the intangible assets. Ultimately, it's the total asset of a building that the company owns. You'll take that asset and you divide it by the shares outstanding. This equation is called the book value per share. When you do the book value per share of a company, let's say you do the book value of a share of a company and you get $100, but yet the stock could be trading at $200, which is way above book value. You wouldn't want to invest in that, and the stock could also be trading way below book value. So if a stock is trading at $100, and you value it, and when you do your valuation, you see that the company has no debt, and you get a valuation of let's say 500. You're buying this thing at a very what Charlie Munger and Warren Buffett and Phil Town will call a margin of safety, a very cheap price. And these investors, the seasoned ones, these guys could go a year, 2 years, 10 years before they even buy the stock. Warren Buffett, he's invested heavy in Apple, but he waited 8 years before he pulled the trigger on Apple. There's also a company that Buffett has also made a position in 2008, BYD company. The stock, he got it in 08 at $2. The stock right now is trading at over $33. So for 10 years, he's been investing, whether it's up and down, but collecting that dividend over time, and the stock went from $2 to $33 because these guys, they're not gambling. If you're just buying a company because you think it's going to go up, or you don't understand the valuation of it, you don't understand what the company does, you don't understand, you don't know the CEOs, you're not looking at the institutional investors, you're just buying it because a friend said so or some type of hearsay. But if somebody was to ask you, what does this company do? You don't even know what it does. Then if the market price was to drop 30, 40, 50%, you just say, no, this is not it, and just get out because you don't understand the company. So we don't want to make those types of decisions, and we don't have to make it hard. You could just, again, simple. Get a company that you understand. You could type in the book value per share, and you could wait till the earnings announcement of this company. Each quarter a company has an earnings announcement, and it'll tell you. They'll tell you their book value per share. You could also look at a company's 10K. These things are a bit more advanced. The 10K, the balance sheet, which is the 10K is a financial statement that companies release annually. To get the financial breakdown of a company. But if you don't, if you don't feel you have the capability to go through these things, you could always type in the book value per share of the particular company that you're looking at. And there's certain apps out there like Stock Advisor, um, different apps that will actually show you, compare the price to book value for you. So we want to buy companies with a wide moat, meaning um, they have a competitive advantage, like a name brand. Like a name brand is very powerful, a very powerful moat. Whether it's Snickers or M&Ms, these companies by the name brand, Pepsi, Coca-Cola, simple things. You want a valuable moat. You want to have it trading at a price way below its intrinsic value. And when you invest a bulk of your. You don't go in. Basically, we don't put a little bit in. We go all in on the company. Because as Charlie says and Warren Buffett says, risk really is just not understanding what you own. If you understand what you're doing, it's not. You don't see it really as a risk, right? Now, that doesn't mean that you're going to be right all the time. Investing comes with a lot of mistakes. And as Bill Ackman says, and success is not a straight line up. Guys like Carl Icahn, when he first started investing, he did really well. He made I think he went from 5 to 70,000, and I think in the 60s to 70s, which is a lot of money at the time. And guess what? He lost it all. So he didn't recommend, but he's talking about how he played poker. So what I did? I started playing poker. Some of these guys play bridge, and it truly, especially poker, it really showed me personally the emotional aspect of investing and the optimism one can have. You think you have the best hand, you wager a lot of money, and you can lose it all. Same things happen in the market. Now, the quote below, Warren Buffett says the stock market is a wonderfully efficient mechanism of transferring wealth from the impatient to the patient. And that's what poker is. You get 5 people playing, 4 people playing, 3 people playing. There's no new money added to the pot. It's just money being transferred really from the impatient to the patient. When these institutions want to buy stock, they want to invest, they can't move $2-3 billion in and out of a position like the retail investor can. They want to get in low. So what they do is they drive the price down. And it's called the stock trade, right? So if you want to buy, someone has to sell. So they drive the price down. Say you get in at 5, they want to buy in at 2. They're going to drive that price in at 2, hoping somebody sells off their shares at 2, then they could buy it back up. Over 90% of retail investors don't do too well in the stock market, but it's not the same for hedge funds. It's not the same for institutions. Why? The difference is the patience. These guys could be in at $10 and see a stock fall to $1. Peter Lynch mentions, when you watch this, watch Peter Lynch's videos, he'll tell you how he got in Taco Bell after doing his homework. So the company had no debt, that they were expanding. The stock fell from 20 to 1. He held it. He actually bought more. How many of us could say that you hold a company from 20 to 1? I mean, it's easy when you have $20. You buy one stock, you said, damn, I'm down $19. But what if you put in 20 million? And you're down 19 million. So that's where the patient comes in. Understanding what you own. Being emotionally stable. Being patient. These particular attributes to hopefully be a successful investor. And that's what we want to do. We want to invest, not gamble. Invest, not gamble. And we do that by doing our homework. So yeah, in a society where social media gives you an instant response on whether you put up a photo or not, or what you're doing, and everything is triggering the mind to have something instant. You go to fast food, your food is quickly prepared. It's just, we're in a society where, patience is not really tried. But in the stock market, in real estate, whatever your investment decision is going to be to ultimately generate cash flow so you don't have to work, just understand that, it's not going to be a straight line up, and it's going to require a great deal of patience. All right, so key backbone to investing, patience, one of the main attributes to have. Hope this was a bit educational, and we'll see you in the next one.